A comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Let's take a look now at the tax efficiency of ETFs with our ETF Research Director, Nina Mishra, who has taken some time to explain this all to us. So we're sitting here talking, Nina, on April the 13th. Tax deadline this year is April the 18th, so
Yes.
people have a few extra days to file their taxes. And we're approaching a tax deadline, but I don't know if many people actually think about the tax efficiency of these types of investments.
Yes, so I thought this would be a good time to talk about tax efficiency of ETFs. Many investors do not know about it. And just to clarify, today we are talking about tax implications for ETFs in taxable accounts.
Okay.
Their tax efficiency in taxable accounts.
All right.
And if you want to learn more about ETFs, appropriate ETFs for IRA accounts and other tax advantage accounts, then you may like to visit our website and read some of the articles that we have published recently that would help you.
All right, I'll remind them at the end of this piece. So what makes these ETFs tax efficient?
First of all, most ETFs track well-known indexes, so their turnover is much lower compared to actively managed mutual funds. For example, for SPY, the most popular ETF that tracks the S&P 500 index, the turnover ratio is less than 3%. So that creates, fewer taxable events and lower tax liabilities for investors. And further, ETFs are more tax efficient due to the way they are structured. And we are going to talk about that in a bit. And if an investor holds an ETF and a similar mutual fund in a taxable account, then the ETF will most likely result in a much lower tax liability for the investor.
Then there's the situation that's known as what, the authorized participant account, right?
Yes, that I have a picture here. So this tax efficiency results from the ETF structure, the unique way the creation and redemption mechanism works for ETFs. We have, for ETFs, they have an authorized participant, also known as the market maker. So creation and redemption process is between the market maker and the custodian of the funds. So for creation, the market maker assembles a basket of constituent stocks for that particular ETF and forwards to the fund custodian. And the custodian in turn issues ETF shares to the market maker. So this process of creation and redemption is, in-kind process and does not have any cash exchanges, and that is why it does not have tax implications. On the other hand, for mutual funds, creation and redemptions are cash transactions and they have tax implications. In fact, a handful of mutual funds even had to, pay out capital distributions up to 30% of their NAVs last year.
Oh, wow.
Whereas for ETFs, it is usually either very low or no capital gains distributions.
All right, we don't want to mislead people, though. There
Yes.
are some ETFs that are not tax efficient.
Yes, investors should know about tax implications of those ETFs so that they are not surprised when they receive those capital gains and the tax bill. Bond ETFs, for example, they have to rebalance more in order to maintain their target maturity and duration, and this higher turnover for bond ETFs sometimes results in capital gains distribution and tax liabilities, but usually these distributions are minimal for bond ETFs. Then commodity ETFs, which are futures backed, they also have tax implications because gains or losses on those futures contracts are taxable. And those ETFs are also required to issue Form K1, which is not really easy to deal with. Then for precious metal ETFs like gold and silver ETFs, which are physically backed and they hold the bullion itself, they also have tax implications because bullion is treated as collectible by the IRS and has a higher longer-term capital gains tax rate.
I see.
In case of currency hedged ETFs, ETFs which hedge out the currency risk, they normally use forward contracts to hedge out the currency risk. And when the US dollar appreciates significantly against other currencies, like we saw in 2014 and 2015, those forward contracts gain in value, and those gains have to be paid out to investors, ETF investors.
Okay.
Then we have MLP ETFs.
Yeah, Master Limited Partnership
yes,
ETFs.
Yes. So ETFs that invest more than 25% of their assets in these Master Limited Partnerships, they are treated as C Corps, C Corporations for tax purposes. They are required to record, mark to market their assets and record deferred tax liabilities on unrealized gains. So for MLP ETFs, those unrealized gains and deferred tax liabilities, they result in large tracking errors. So that is something which investors need to keep in mind.
All right, a lot of information to digest. Hopefully we've helped some investors with that information.
Hopefully.
If you would like more information on ETFs in general, as Nina said at the top of the segment, other commentary or articles about tax efficiency of ETFs that are related to what we talked about here, get on over to our website, zacks.com. You can access it all in the ETF section of the website by using the top toolbar on the home page, and that's the tab that is labeled Funds. If you click that, a little drop down will occur, and it'll give you the option to go to the ETF section of zacks.com. With Nina, I'm Terry Ruffalo.